Welcome, everyone. I am so glad that you're joining me today on my real estate show. What a whirlwind have we been through this last week. It's just been incredible, and unprecedented times. So I'm willing to just put that to the side for just a minute. And I hope that you do too, because we have some positive messages to share with you guys. And one thing that's always been consistent is the benefits of homeownership, regardless of what economy or what crisis anyone has been through. It's always been, a place where we seek refuge, where we get shelter, where we recharge our batteries. So I want to just go ahead and put attention into that, the benefits of homeownership. And there's a lot of them, obviously, some of which I just mentioned. But today I want to focus on the tax benefits of homeownership. And I have a dear friend of mine who knows a whole lot about it, JWells from JWells CFO, who's going to be joining us today. So please help me give him the warmest welcome. Hi, Jeremy.
Hi, thank you so much for having me.
Yeah, absolutely. I'm glad that you're here with me today. And we have a really positive show prepared for our audience here. We want to keep it, bright and happy and focus on the positivity. And this being a real estate show, obviously, it would have to deal with the benefits of home ownership as it relates to tax advantages specifically. So
For sure.
You being an expert in that field, I'm delighted to have you on the show.
Good deal. Glad to be here. Thank you very much. And yeah, absolutely. There are definitely some benefits. There's some costs, but there are definitely benefits. And so, always happy to talk about it. In fact, it's a conversation I get into with clients a lot, especially my, younger clients that are living in the more metropolitan areas. And so home ownership really hasn't been on the radar as much for them, but they're thinking about it. They're thinking about starting a family, moving out to the suburbs, those kinds of things. And so obviously home ownership is a big issue.
Fabulous. So let's talk in terms of single family homes or even a condo that is owned and occupied by the owner. There are certain benefits for primary residents. So let's talk about that, and then we'll get into a later part in this video as to how it relates to investment properties, because I know there's even benefits for those as well. But the one I think that we most commonly can understand would be the living at home type of benefits. So what are the benefits of home ownership for someone that's actually living in their primary residence, Jeremy?
Yeah, well, I think, a mentor of mine once told me, even though you're a tax professional, it's not always about the taxes, right? And so I think, like you said, you hit on it. First thing of home ownership is that it is your place, and even with a mortgage, even with those costs, you own that. You have the right to that space. So you don't have, the neighbors right on the other side of the wall. You don't have, the landlord that's constantly telling you what you have to do or can't do, or those kinds of things. And so, home ownership automatically grants you those kinds of privileges, and it just gives you a place to stake your flag. It's a place that you get to call home. On the financial side of things, it does give you that opportunity to build up that personal asset and the equity in that asset. And so, if you do get into a situation where you're wanting to move, if you've built up equity in that home, then you can apply that equity toward, the moving costs or the next purchase of your home. That's what my wife and I did. So our first home we purchased together was when we were living in Texas a few years ago. We got lucky. The market had appreciated. A couple of years later, when we wanted to move to Florida, we had made enough off that sale that it gave us some money to live off of when we moved to Florida. And then it gave us our 20% down payment on our condo here in Florida. And so, having that appreciation, and we didn't really, have to put a lot into it. We repainted, that kind of stuff. And then inside of 2 years, we were able to roll the gains over into our next place. And so, that appreciation is of course something that you're looking for also. And that brings up another aspect that, I'll circle back around to is what happens on the tax side when you do go to sell your house. Because, that's another part of it too. But then getting into the actual tax benefits of home ownership. So this is this is where it starts to get a little technical, and this is where the eyes start to glaze over a little bit. But really, you have to realize that when it comes to your personal taxes, so like you said, right now we're talking about your personal residence. So we're only worried about your personal tax return, your 1040, that thing that's due, a few weeks from now. When it comes to your personal taxes, in general, right, there is your gross income, all of the reported money that you made last year, right? Whatever your W-2 says your wages are, or whatever your 1099 says your business income was, right? And then from that, we get down to what we call your gross income, right? And this is after all of those business deductions if you're self-employed. This is after all of those adjustments to your income if you're working, if you have a W-2. And so those are the things that you take off on that front page that are the things like your student loan interest, or if you put money into a traditional IRA, you get to take those things out. This gives us what we call adjusted gross income. Mm-hmm. Then there's one more calculation that we do, and that gets us to your actual taxable income. And the biggest part of that is taking either the standard deduction or what we call itemized deductions. So everybody can take the standard deduction, almost everybody. There are some limited exclusions, but in general, everybody can take the standard deduction. Now, this changed pretty significantly with the 2017 Tax Cuts and Jobs Act, which has been in effect since the 2018 tax year. So with that, the standard deductions essentially doubled. And so if you were single, your standard deduction went from a little over $6,000 to now it's a little over $12,000. And if you're married filing jointly, it went from a little over $12,000 to now a little over $24,000. And so to take your adjusted gross income and then reduce it by the amount of the standard deduction gives you your actual taxable income. And that's the number we look at when it comes to thinking about how much income tax you're going to pay. So you're always paying income tax on a number smaller than all of the income you're actually making. Now, here's where, working with your tax professional comes into play, because you're also allowed these things called itemized deductions. And this changed with the Tax Cuts and Jobs Act too. But a couple of the things that stayed constant after that were your mortgage interest paid last year. You get to take that as an itemized deduction, and the property taxes that you pay on your primary and your secondary residence. So if you own a second home that you're using for personal reasons, you get to take the mortgage interest and the property taxes on those as itemized deductions. Now, here's the key. If the total of your itemized deductions is more than what your standard deduction would be, then you take the bigger number.
Sure.
Right. So sure. You can't take both. It's one or the other, but it's whichever number is bigger. Right. Sure. So if you're in a situation where you own a home and you've got a fairly sizable mortgage on it, so that you're paying a lot of interest throughout the year, and it's just the interest, it's not the principal portion of the payments, it's only the interest portion of the payments, but you usually get this from your bank reported to you on a 1098. So if you had a mortgage last year, by now, probably a month and a half ago or so, you got a letter from your bank or your mortgager called a 1098 that has the amount that you spent on mortgage interest last year. So it's that number plus your property taxes. And sometimes it's on that same form, because if you have your property taxes being paid out of escrow, right? So if you're paying more in your mortgage payments, but then they're paying the property taxes for you, they'll report that number there. Otherwise, it's just however much you paid to the county clerk's office or the county treasurer's office in terms of your property taxes. Gotcha. So you take those two numbers, right? And that is essentially the tax benefit of home ownership, because if those two numbers plus a couple other things, there's charitable deductions, those are really the three itemized deductions that we're left with now after the Tax Cuts and Jobs Act. So you add up your property taxes, your mortgage interest, and your charitable deductions, and that gives you your total itemized deductions. Okay. And if that number is, sorry. So if that number is bigger than your standard deduction, then you take that total.
Fabulous. So one quick thing about mortgage interest is a lot of times the way these mortgages work is you pay more interest towards the first years of the loan, right? So if this is a scenario where there might be a first-time home buyer, or even a move-up buyer, moving into a mortgage that's much larger than the one they had before, obviously that payment as it relates to the interest on that loan would be higher during the first few years. And then it just kind of, reduces itself over a 30-year period. But it's a great thing to be able to have that as one of the benefits that you can include in your taxes to reduce the tax liability. So that's fantastic. Now, do they get to write off the whole interest on it? So let's say if you paid, just to make it easy, and for, let's say, $10,000 in payments, and out of those, 3,000 of those were, the interest. Do they get to write off the whole $3,000 of interest on it?
It's that entire amount of interest that you paid, right? So, and that's what you'll see reported to you on that 1090A. There's a box that will say this is the mortgage interest paid, and that's the number that you're going to report on your tax return. Now, you brought up a good point. So when you think about the mortgage payment, assuming that you don't change anything about that mortgage, you don't go back and refinance, or you don't go back and you take out additional credit against that equity or anything, assuming the mortgage stays the same, that mortgage payment over the life of the mortgage will never change as far as the principal and the interest goes, right? The combination of those two things. Now, your escrow might change because property taxes change year to year. Those kind of, the assessed value might change year to year, but the actual, what you're paying toward the balance and the interest due on that mortgage, that will never change, as opposed to something like rent, where your landlord can come back every year and increase it that 3, 4, 5% or whatever. And so it's always going up every time you re-sign. Your mortgage payment each year is going to stay the same, except for that part that might be going to escrow.
Absolutely. And one other thing, they get to write off the whole interest. Do they get to write off the whole tax payment as well, the property tax?
And so that's a good question, because that's another change that resulted from the Tax Cuts and Jobs Act of 2017, late 2017. So you are able to claim the full amount of whatever you pay in what's called state and local taxes, or SALT, right? State and local taxes. So that's your property taxes, that's your state income taxes. We're in Florida, there's no state income tax here, but I have a lot of clients in other states that do have income taxes. So you take all of your state and local taxes, you add that number together, and the total up to $10,000.
Up to $10,000.
You can take as on that Schedule A itemized deduction. So that is that's one issue that we've had to deal with as a result of Tax Cuts and Jobs Act, is that the cap, that $10,000 cap on your state and local taxes, it causes problems, especially for people that live in states with an income tax. In Florida, not so much. You have to have a pretty big piece of land with a really nice house on it to have property taxes over $10,000, going on. So it's not been as big an issue in Florida, but in a lot of states with income taxes, it is an issue.
Right. So if you're listening to me from outside of Florida, this is one of the more popular places to retire in, not only because we have great weather for the most part, but also because of the tax advantages with homeownership in our state. In addition to everything that you just mentioned, there's something that's very particular to Florida, as well as some other states, but not every state, and that is the homestead exemption, which is something that helps us reduce the amount of taxes that we pay by the amount that the value of the house is how it's calculated. So tell us a little bit about that, as it relates to home.
So this is something I'm not exactly an expert on, because it really, it's a fairly simple thing to set up. Once you actually have, recorded that you purchased this house, once you've gone through closing and, the dust has settled from closing and you're staying in this house and everything's in gear, then you go down to your county courthouse and or government center, and you go to the right office, which is usually, I think, the county clerk's office, and you fill out the paperwork they tell you to fill out. So really, your county clerk's office is where this is going to happen. But in general, in the state of Florida, what happens is you have, and this is true of all the states, but focusing on Florida, you've really got three different numbers you got to worry about when you own your own home. And the first one is, the actual value of the home. And that's going to be determined by the market. That's going to be determined by the appraisals, all these different kind of things. The other one is the actual balance on your mortgage, right? If you've got that mortgage, what you're paying off. That's the second number you need to worry about. Hopefully you're trying to get that number down over time, right? If you're doing the responsible thing. But the third number is the assessed value of the home. And that is up to that is up to your county property appraiser, and that is a government position. And so that number, I've had conversations with people who they look at the assessed value and they get really irate because it's so different from what they think their home is actually worth. And it is, right? Because the assessed value, it's not the market value. It's not the value that you owe on your mortgage. It's a completely different number. It's come up with a different number. But here's what happens in the state of Florida. If you own that property as your primary residence and you're not living somewhere else and calling that your primary residence also, this is important to keep in mind. You're only allowed to homestead one property somewhere in the world, right? One property is your primary residence. If that one is here in Florida, then you can apply for what's called the homestead exemption, which is they take the assessed value, which is what they would calculate your property tax on. And on the first 50,000 of that value, you get an exemption of up to 25,000. Then on the next 50,000, you can get up to another exemption of 25,000. So if you look at the actual invoice from your county tax collector, you'll see the assessed value, and then you'll see those two different exemption amounts if the assessed value is high enough. And it'll essentially bring the taxable assessed value of your home down by up to that 50,000 amount. And so, for most counties in the state of Florida, you're looking at an effective property tax rate of somewhere around 1%. So if you bring that assessed value down 50,000, you're looking at saving about $500 a year in property taxes. And so that's what that homestead exemption does. Another part of that is essentially it locks in the value of that home, and that the assessed value of that home. And so when you have that homestead exemption, it stabilizes that assessed value over time. And so it keeps those property taxes reasonable. Again, I'm not an expert on how all of this works. That's for your, county appraiser's office or county clerk's office. But in general, on average, it's usually about a $500 property tax savings each year.
Great. Now, so we talked about the benefits of homeownership as it relates to your primary residence. Now let's go into investment properties, which has always been, one of the ways of building wealth in this country, regardless, again, of what type of economy or market we might be in. Real estate has always been one of those vehicles that has created a lot of wealth in the United States. So we know that is not just by the strategy of owning a home for you to live in, but also for investment. Mm-hmm. And as it relates to that, what are the tax advantages involved with, investment properties?
Yeah. So here's the thing from a tax perspective, especially from a federal tax perspective, a rental property it's essentially operates as a business, meaning that you have revenue that comes in and you have expenses that go out. And so as far as thinking about what you're actually taxed on, you're taxed on the difference. You're taxed on the difference between the revenue that comes in or that rental income that you're collecting on that investment property and the expenses that you paid out throughout the year to keep that rental property functioning. So all of the things that go into maintaining that rental property that you as the owner are actually paying for. So the HOA dues, the property management fees, the cleaning and maintenance, the landscaping, the utilities, if you're paying the utilities, if the renter isn't paying the utilities, all of those different expenses you get to deduct from the rental income in order to come up with the number that you would actually be taxed on. Mm-hmm. There's one additional number. Now, you don't get that benefit for your primary residence, for example, right? So, we talked about that before. The two deductions that you can take for your primary residence are your mortgage interest and your property taxes. Those are the only two things you can take. You can't take utilities. You can't take landscaping, all that. With a rental property, you can. You can deduct all of those things. In addition to the mortgage interest and the property taxes on that rental property. So you get the benefit of a lot more deductions when it comes to that. You're also not renting, you're also not making a lot of rental income off your personal residence. But so that's the difference with a rental. You're making income, but then you're also offsetting that reportable income with those deductions. Now, Now at that point, see, this is what you're actually out in terms of cash flow, right? And so this is where the tax benefit of a rental property comes in, because you have to think about two different things that are happening here. One is the actual cash flow. So if you look at the end of the year, all the rental income you collected throughout the year, less all of the money that you actually spent on maintaining that rental property, hopefully there's something left, right? Hopefully you've actually still got a little bit of money in your pocket left after all that. So that's the cash flow. With a rental property, there's one more big expense that you get to take, and that's the depreciation expense on the property. So, what's depreciation? Depreciation is the idea that when you buy something of pretty substantial value that you expect to last a long time, like a building, right? Whether that's a residential building or commercial building, right? You expect that building to be there for a while, and it has a relatively substantial value. So you don't take the expense of what you paid for that property all at one time. You spread that out over time. Now, the IRS has regulations on how we can do this. And so for a residential rental property, like a single family home that you're renting out, the IRS lets you break up the cost of that property over 27 and a half years. Okay. Why 27 and a half? Who knows? That's the number the IRS came up with. But you take the actual cost of that house when you convert it to a rental, you divide that by 27 and a half, and you get to take that amount every year as depreciation expense. But you're not actually paying that cash out every year. You're just reporting it as depreciation expense. So what happens is you've got that cash flow that's left over at the end of the year. But then for tax purposes, you take that other depreciation expense, and that's what you're actually taxed on. So in general, if you do it right, if you do your rental property right, you've got some positive cash flow. The depreciation expense on paper zeroes that out, and you don't really have any taxable income from that rental property. So it's essentially tax-free cash flow is what you're aiming for with a rental property.
Okay, and then from a market standpoint, the way I see this is you have the benefit of all of those tax write-offs, but at the same time, the value, the market value of that property, of that asset is actually appreciating.
Yeah,
so you're actually building value and building capital by the appreciation on the market side, and then enjoying the benefits of the depreciation on the tax benefit side.
Exactly. And that's the other thing. So let's say, if you buy a pretty substantial piece of property, and this is true of whether it's a duplex or a fourplex or something bigger, right? And so you're taking that depreciation over those 27 and a half years. And depending on how much that cost of that property was at the outset, that can be a relatively substantial number compared to your actual cash flow. And so what ends up happening is a lot of times on paper, there's actually a loss. So even if you're making a little bit of money off of it, on paper, you've got a loss. Now, what happens is, because the nature of rental properties in general is what we call passive income. Now, it might not feel passive when you're the landlord, but in terms of what the IRS calls passive, it's passive income. You can't offset active income like wages or what you're making off your business. You can't offset active or ordinary income with passive income. But what you can do is keep track of those passive losses year after year, and they accumulate. There's no limit to how long those passive losses off that rental property will accumulate. So let's say you took a couple $1,000s in these passive losses on this rental property year after year after year, and it accumulates over time. Well, when you go to dispose of that rental property, you sell it, right? Or you sell it to the next investor. You make some gain, you've had some appreciation, right? So on paper, you've made some money off of this property. Well, now you get to take those accumulated passive losses and offset some of that gain with that. So that's actually, there's a short-term, tax benefit in that you're getting this relatively tax-free cash flow. There's also a long-term benefit in that if you're showing these paper losses year after year, you get to offset the actual gain when you sell.
Gotcha. Yeah, it's a beautiful thing. And it's a kind of topic that I don't hear, being talked about at schools or, this
Right.
is knowledge that you really have to seek out to set yourself up for success as it relates to, building wealth and investing and, and taking advantage of the tax write-offs that are available to you as a homeowner. Obviously advantages on both fields, the home that you occupied as your primary residence, numerous advantages on that. Like we were talking about, it's a place where you recharge your batteries. It's a place where you seek refuge, especially during these times. But then also there is the tax benefits associated with that. So, just a quick comparison to, the alternative, which would be, a rental payment, for example. Any of the benefits that we've talked about up to this point since the beginning of the video would be completely off the table with a rental situation. Is that right?
Yeah. Yeah, absolutely. Absolutely. If you're renting, then you're just generating that income for your landlord that they're going to turn around and take that cash flow and not have to pay as much taxes on it as you would think. And so, yeah, you're basically passing on all those benefits to your landlord when you're renting.
Exactly. So if you know about these benefits and you have the ability and the stability to make a sound investment on this, we have the tools, we have the strategies, we have everything that's necessary to help you set yourself up to take advantage of this, which I think is a beautiful thing. And also just one other thing, how it relates to rent, you brought up a good point. When someone buys a home, that payment is locked in. With maybe a slight fluctuation on the taxes, maybe the HOA fees, but the actual principal and interest payment gets locked in for 30 years. And that's a given. Right now, we're seeing historically low interest rates. They're kind of volatile at the moment, but they're still very, very low. Regardless of the volatility, I still think it's a great time to take advantage of some benefits as it relates to lower interest rates and then tax benefits. But then also, rents tend to go up, and they historically have continued to go up, where the benefit of locking in your mortgage payment is being able to budget yourself in a way that's not going to, include any surprises when it comes time to renewing your lease. So there's really great possibilities and great benefits to investing in a home as it relates to your primary residence and also your investment property.
And there's one more thing. So, to bring it back to your personal residence, and then also on this point of appreciation, right? So you hope that this property goes up in value over time, in market value. And this is true of your personal residence. So not of rentals, but of your personal residence. When you own your home and you go to sell it, and it has appreciated. So, let's say you bought this home, at some point in the past, you bought this home for, $200,000. And now based on the market, you're going to sell it for $300,000. So you have a gain of $100,000 on this house that you're getting ready to sell. Now, if this is your personal residence, and you're single, then you're allowed to exclude up to $250,000 of gain on your personal residence when you sell that home. If you're married filing jointly, it doubles. So you can exclude up to $500,000 of gain. So what does this mean? That $100,000, if it were a rental property and it went from $200,000 to $300,000 and you sold it and you had that $100,000 of gain, that would be capital gains to you. That would be taxable income as capital gains. Because it's your primary residence, you get to exclude up to $250,000 if you're single, or $500,000 if you're married filing jointly, of that taxable gain. So you essentially don't show any gain for tax purposes, which is another great benefit of owning that home for the long run in terms of your taxes. Yeah.
Fabulous. So it's almost like the tax system is set up to incentivize people to make a purchase on their primary residence and even investment properties. Is that right?
Absolutely. If there, you can tell that there are certain industries that have had their way with the Internal Revenue Code, and real estate is definitely one of those. And if you think about it, real estate drives our economy, right? I mean, it really does. That, we saw this in the late 2000s, that it went, as goes the real estate market, so goes the economy. And so there are lots of things in the tax code that point to supporting the real estate industry and supporting, what ultimately ends up being, the financially responsible thing of home ownership, investing in property, and supporting the real estate market for sure.
Fabulous, fabulous. So, well, it's been a pleasure having you on the show, Jeremy. If you would tell us a little bit about what you do and types of services that you provide. Should anyone that's watching right now could benefit from connecting with you, I'd love to be able to make that connection.
Absolutely. So my firm is a full service accounting firm. We do tax preparation, tax planning, as well as bookkeeping and payroll for small businesses, especially for independent contractors, realtors, real estate agents and brokers, and anybody in that space. So, those in the more on the handyman, the insurance, the mortgage, all of that. Anybody that is looking for help running their small businesses, but then also on the tax side of things, we help them out.
Fabulous. And you do so in a way that is very easy to understand. When it comes to tax code, I think it's a different type of skill. It's very precise. It's either black or white, and you just have a way of just presenting that in a way that's very relatable. So I appreciate you being on my show and sharing all your expertise. Should anyone want to get in touch with you, I have your website scrolling through our video here, the JWellsCFO.com. Is that the best way to get a hold of you?
Yeah, absolutely. If you go there, there's a big button that will take you to scheduling a consultation with me. It'll automatically, you pick a time that works for you. It'll automatically put that appointment on both our calendars, and we'll have that call ready to go.
Fabulous. All right. Well, with that said, again, I'm extremely appreciative of you joining us today. I hope to have you back on the show again sometime soon.
Absolutely. Thank you very much.
All right. Well, hang tight. I'm going to go ahead and wrap it up. All right.
Okay.
All right, guys, there you have it. I hope that you enjoyed this episode. I think it was definitely super valuable with all the tax benefits that homeownership brings in this country. So I encourage you to take a closer look at this. If you are not currently enjoying the benefits of homeownership, I would love to help you through that process so that you can start enjoying the benefits of homeownership. Best way to do that would be to schedule a simple consultation with me. We could do this virtually nowadays. I'm offering virtual meetings, and it's just simply a discovery session where we can talk about where you guys are at in terms of homeownership, what your goals are, and then develop a strategy to get you from point A to B. So I look forward to connecting with you. Best way to do that would be to connect with me. You can call me. My cell phone is scrolling right through the marquee. I also have a seller's guide that I want to make available to you guys. So it's a free download. And if you are thinking, is this the right time to sell? There's a lot of things that you have to keep under consideration. I'd love to give you some insight as to what those things are. And we can do that very easily by scheduling a call. So with that said, thank you so much, guys. I hope that you enjoyed this episode. Remember to be kind to one another, and I look forward to seeing you next week. All right. Have a great day.